Welcome one, welcome all to the Sunday, February 6, 2011 Deathburger Report. This is financial fun at its best and worst. This is John Galt speaking from the Watchman.fm. You can tune into my show weekly, Monday through Friday from 7 to 9 p.m. Eastern Time, only at www.thewatchman.fm. Go to johngaltfla.com for details. The Dow this week had a nice rally. The dead camel bounce continued through the week. This is the 3-year weekly chart of the Dow Jones Industrial Average. As you can see, it has recovered nicely, but not back to the previous highs from back in 2008, 2007. Same for the S&P 500. The S&P 500 large cap index is following a similar pattern. I find it unusual that the bigger cap stocks have not caught up to the small cap stocks, but that is not something to sit there and dismiss entirely. Odds are we will rally higher. But will we make all-time highs? Not sure. NASDAQ has recovered completely from 3 years ago to this point in time and is well above where it was in February of 2008, right before the financial crisis started to really take hold and wake everyone up. We don't know if that means that this is setting up for a major fall, but we do know one thing: inflation is running rampant through the system, as the Russell 2000 also reflects the risk-on formula, but it did not as an impressive a pattern, and seems to be consolidating here around the 800 level for either a major move up or a major break down. Why should you be concerned? Well, it's really quite simple. Pay attention to the man in charge. Yes, this guy, Mr. Marlboro Man. The news this week economically wasn't that impressive. The news this week overseas was not that impressive. When you take into account the foreign policy blunders we've witnessed over the last couple of weeks, in addition to the obviously bad economic news, you have to begin to wonder. I mean, people are putting risk on for a market that still is not open. Now, the EGPT is pictured here, the Market Vectors Egypt Index, rallied, fell, and then fell again this week. Obviously, people have no clue what's going to happen, but they're going to pile money into it. Odds are, starting next week with the hint of a deal, they'll pile into it again. But the long-term implications of the world economy, as expressed by the Baltic Dry Index, this sucker's about to go into triple digits. We're heading back into territory we haven't seen since the 2008 lows, and it was a precursor to the economic collapse that we saw. Also, some other areas aren't looking so good. Some of the financials are still looking ugly. The regional banks and one major national bank, Bank of America, still looks horrible. They just had a major settlement because of their mortgage division, and now they're splintering off their bad mortgages into a separate company, which is basically saying we're going to put our big pile of poop in the other room, and please, that smell is not from the headquarters. BB&T, similar situation, not so much as far as the idiocy at BAC, but the pattern on the chart is somewhat similar. It is not looking very strong on a 3-year weekly chart, and all the charts you're seeing tonight are 3-year weekly charts. Reason being, I wanted to give you a long-term perspective. Not impressive. We'll see what happens here if it breaks or rolls over. Same for the KBW Philadelphia Regional Banking Index. We have not made a new high to verify what is going on with the major the small cap indexes, the Russell 2000 and the NASDAQ index. Now, the S&P and the Dow seem to be following an even better pattern than the regional banking index, but it makes you wonder if people are starting to sniff out the problems. When you look at the charts of the various ones, I'll pull Zion's up, for instance. Here's a 3-year weekly chart of it. Another consolidation underway. Attempted to break out, failed at the end of last year, and now is bouncing around in the from last year into this year. No real discernible pattern, and there's a reason behind this. There's been no recovery in the real estate market or the commercial real estate market. We had a report this week that there was a 17.4% delinquency rate on multifamily commercial mortgage-backed securities, which leads us to the next problem. That's right, my friend, Municide. People think that this isn't going to cause a problem. The bigger problem is that without property tax income coming in and new home sales, especially the ones by owner, being generated, we're not going to see a recovery in the markets. Meredith Whitney is correct, and it's going to cause more problems for the regional banks, which will lead to our next crisis. Here's my chart for total private construction on an annual basis per the Bureau of Census from the Department of Commerce. We hit $507.334 billion in 2010. We haven't seen levels like that since the 1997-1998 time frame. That's a horrendous number. This means that private building is contracting and continuing to contract and probably on a pace to reach a 1995 level. This will crush the cities and cause Municide to expand. On the unadjusted purchase mortgage managers from the Mortgage Bankers Association, the unadjusted purchase applications from the MBA is still down. We've had no increases. We're down from 2010, which was down from 2009. People aren't buying homes. The people who are buying homes are buying new homes custom built. They're not buying, or they're buying investment homes, but not in the kind of numbers that's going to clear the shadow inventory. Let's look at the municipal bond indices, various ones. Here's the Nuveen Advantage Arizona. Arizona has not recovered. It had a nice rally from the 2009 low, failed recently with the quote-unquote PIMCO crash on municipal bonds, and now you see this picture here showing a market which is in a short-term consolidation for the last several months on the 3-year weekly. Looks like it's about to roll over. It is not going to end well for the muni bond market if this continues. Also, here's your California Municipal Income Fund from PIMCO. Once again, a similar pattern. Nice rally off the lows. The bad news came in shortly after Meredith Whitney spoke and did her little report. And we see again a short-term consolidation looking like it's getting ready to break down for new lows. Another PIMCO fund that I have here in the display, 3-year weekly chart, the Municipal Income Fund. Same situation, nice rally in the last 3 weeks, but I don't think that's going to hold. And I think we're going to see a rollover as we consolidated a little bit at the end of last week. No major conviction or move in either direction. I think we start to break out and roll down to the downside. Finally, the New York Municipal Income Fund from PIMCO. You see the same pattern as California and Arizona. You'll see it for Florida and Georgia and Illinois and other states. This one looks like it's ready to break down. People do not believe it's going to be a success, and is causing a lot of concern in Washington, D.C. This guy doesn't know whether or not to smoke another one or another 5, or to sit there and pray for more hyperinflation so they can sit there and buy up all the muni bonds. It's going to be a problem. The dollar is indicating that it will. Here's the UUP Power Shares Bullish Index Fund, and it's falling apart. And right now it's got a horrible target. It looks like it's got a target area of 21 to 2150. Not pretty. I've drawn the lines there. You can see a massive downturn after that rally in 2009. It should be rallying up based on geopolitics in the world. Also, when you look at the UDN, the bearish dollar fund, it's doing nicely. We had a very bad week last week, but overall it's in an uptrend. And it has got a potential, and this is a 3-year weekly chart, to sit there and climb up and test the areas up around the 2850, 29, 27, 2850, 29, 2950 area. If it gets into that red zone and breaks out of that, we'll see the dollar make new all-time lows, which would be a good thing for Obama and the municipal bonds because now people can buy it up with cheap dollars, and it would be a very good thing for gold, which has already doubled. Look at that chart. From the lows that we saw in 2009, we've hit over a double in gold in just a year and a half. Good for gold bulls, good for silver bulls, bad for people who wish for a sound currency. This is not going to end well. Meanwhile, the big financials are indicating that cheap money and hyperinflation is good. 3-year chart of Goldman Sachs looks fantastic. 3-year chart of JP Morgan looks fantastic. And the 3-year chart of Morgan Stanley. All of which indicate that this medium to intermediate term consolidation is going to result in a nice rally. Why is this happening? Dilution of the dollar. Here's the trade-weighted dollar index against major currencies. We have trashed this sucker for 25 years. We've had no recovery in the last year. In this, we've had a couple of dead cat, or shall we say dead camel bounces, but it hasn't improved. Let's start looking at the economy in whole and the employment situation. The civilian participation rate is at a record low that we haven't seen in over a decade. And folks, this is a very bad sign. We're heading back into areas and territory that is indicative of an economic depression or massive sea change in our economy that we never anticipated would happen. When you look at other charts, like the fires versus hires thing, a part of the JOLTS index, which is recently created since 2000, you see a total disaster occurring there. This nightmare, this problem is they claim there's more job openings, but they're also counting a lot of these job services. These job services and like Craigslist and stuff where fraudulent jobs are being posted. The truth is, without construction in the United States and without a moving of the dead inventory, there is no real economic recovery, at least not for the lower and middle classes. While there might be an upper middle class recovery, a financial systems recovery, it is not working, and it's costing people who can't afford it more money. This is part of the riot problem. We've deteriorated and destroyed the dollar to a point below 74 in the dollar trade, the major currency dollar trade weighted index. But you look at this chart versus food inflation. The red line is food inflation, consistently growing. The dollar consistently declining since 1973. It's not a big part. Look at civilian participation rate versus home ownership. Home ownership rates decline as the participation rate in the employment workforce declines. Very clear, not even a rocket scientist kind of thing to sit there and develop as a theory. It's obvious, and it's not going to improve. Manufacturing employment is a disaster. We have not seen it this low since World War II, but we're under the impression that our economy can recover without any kind of manufacturing, without the development of or renewal of a manufacturing base. This is a myth. If you have no construction and no manufacturing, then it must be in other fields that we're going to sit there and create and expand the economy. When you look at the durable goods manufacturing even, it's at a historic low. We haven't seen it in this level since the 1950s and 40s. And the population was considerably less. I'm using the Federal Reserve's own data going through this last report on Friday. It gets worse when you look at the non-durables, your paper towels, your consumer disposables. We've never had it this low before. Granted, part of this is due to technological innovation. Granted, part of this is due to companies coming up with more creative manufacturing techniques. But on the flip side, we've exported a large portion of these jobs, and there's no recovery on the horizon. So everyone says, well, we'll just get a job in the service-producing industry. Yes, we have, but we flatlined. We hit a peak back in 2008. We dropped dramatically. We've come back down, and we've basically flatlined in the quote-unquote recovery period. That's not supposed to be a sign of help. That is a sign of a crisis that's building. When you look at the next thing, they said temporary help. That's the future. Well, temporary help had a spike coming out of the quote-unquote Great Recession and is now rolled over and declined severely in the last couple of months. We see once again the theory and bullcrap being promulgated by the economists is not coming true. If temporary help is declining, that means there's no more permanent jobs being created, thus the plus 36,000 figure. U.S. construction jobs, lowest since 1995. We can't sustain the economy without building things, whether it's in manufacturing, whether it's via temporary help, non-durable manufacturing, goods and services. We're not making things in this country anymore. They said, oh, maybe they went to financial activities. We've gone down in that also. We're back to levels we haven't seen since before the 1998 dot-com bubble burst. Once again, it's flatlining and declining. Technology and outsourcing is replacing it. Goods producing services overall, a disaster. Back to 1952-55 levels. We're not going to make it, folks. Meanwhile, the government jobs continue to increase, even though government jobs decrease slightly. Leisure and hospitality, flatlined, just like the other industries. We're not seeing the kind of improvement. So where are the jobs coming from? Maybe it's, nope, not transportation and utilities. We've had a massive decline. We've done a U-turn slightly. We haven't recovered back to 2000 levels. We're still at pre.com. Retail trade, flatlined also, still back at mid to late 1990 levels. Folks, tune in to the voice of Galt on the Watchman.fm. Stay tuned at www.johngaltfla.com. The crisis is ongoing. We haven't seen a solution, and the statistical voodoo is about to come home to roost. God help us when America wakes up one morning and sees one of our major cities looking like Cairo. Good night.